Wonderful Word of Money, and I've brought with me two special guests. They are Jeff and Lori Staron. Welcome to the show.
Howard? Good to be here.
Great. So tell me something. What kinds of investments are there out in the market? I hear there's bonds, we have stocks, GICs. Why don't we start out with stocks?
Okay. Let me start, Howard, by differentiating between two basic kinds of investments. And any kind of investment we talk about tonight, or any investment anybody would want to talk about ever, can be broken down into one or the other. Either you're acting as an owner, or you're acting as a lender. And for the most part, that is what the difference is. If in some cases there are some hybrid things that cover both owning and lending. However, as an owner, you're looking at something like a common stock. As a lender, you're looking at something like a Canada savings bond, which a lot of people can relate to, government bonds, corporate bonds and debentures, a preferred share, a preferred stock, for instance. I consider that, in most cases, to be acting as a lender rather than an owner. That's how I draw the line.
So if I was interested in investing in something and I have, let's say, $10,000 and I go to a stockbroker, how is he going to advise me what is best for me, and how do I know if his advice is going to be the most appropriate for what I'm thinking of doing?
Well, I think appropriate is probably the key word, because what you have to do is, if someone asks me, is this a good investment? For someone who's 25 and has high income and has 50 years of investing ahead of them, maybe yes, but that same investment for someone who's 75 or 80 may not be appropriate. So matching the person's objectives to the investment is quite important. And what I generally get down to doing with most of my clients is I try to assess whether they need to be acting as a lender or an owner with the bulk of their investable assets. Probably the key investment for most people would be their residential property. And that's going to be a very large, especially in Toronto, a very large item. If someone has, say, $300,000 or $400,000 invested in a house, and they have $50,000 or $100,000 available outside of that, then that person would have certain investment alternatives. Someone that has no house and has 10 or 20 or 50 or whatever amount of money, each person is different. So it's very difficult to generalize, but I think that the key is sizing up what the person's objectives and expectations are. Some people have a lot of tolerance for risk. Some people are very risk averse. So in some cases, common stocks would be not appropriate for someone. In some cases, by not having common stocks, I think the person is perhaps missing out in terms of future potential gain. So it varies. You can't say this is a one individual investment that's appropriate for everybody.
If I do not want to invest in bonds, what do you think is probably the least riskiest investment to go for?
Right now, it's very topical. Anything that has a government guarantee is the least risk. For amounts of $10,000 or more, a lot of people offer treasury bills. That's government guaranteed, no risk, or it's the smallest level of risk in the country. Guaranteed investment certificates, again, up to $60,000, if it's covered by the Canadian Deposit Insurance Corporation, there's no risk. There might be a little bit of aggravation if you were to invest in a small trust company and they had mortgage problems. There may be some delay in getting your money back, but still, it's guaranteed by the government. So the least risk would be probably treasury bills. Anything to do with a bank is one of the big 5 or big 6 banks, no risk. Term deposits, GICs, from a bank and or a trust company.
How do treasury bills work in terms of buying them?
Well, it depends. There are a number of institutions you can buy treasury bills from. An investment dealer, like the one I work for instance. Some banks will limit you to minimum purchase amounts of $50,000 or $100,000. So probably an investment dealer is a good place to start. Then I'd try your trust company or bank and ask for a competitive rate.
So let's say I buy a treasury bill for $50,000. How long do I have to wait before I can achieve interest or make a lot of money with it?
With a federal treasury bill, and there are provincial treasury bills, but they're not quite as common, you can invest for terms of 1 month, 2 months, 3 months, 6 months, and a year. Occasionally something in between, but Treasury bills do not go longer than a year. That's the maximum term. If you want it to go longer than a year, there are other vehicles that are available. But I think the key is, I talked about ownership assets initially when we started versus lending assets. Historically, over the last 40 years, let's say, if you were to buy Treasury bills and pay tax on your investment income, you would basically have kept pace with inflation. You'd be even, not plus or minus. If you were to invest it in common stocks, in a well-balanced portfolio of blue-chip common stocks, you probably would have averaged, over the last 40 years, 5 to 6% per year compounded return. So that's a significant difference. That's why, again, someone that inherits $200,000 or $500,000 and says, I want to keep it all in T-bills, if inflation is 12 or 13%, in 5 years, $1 million is worth $500,000. You have to make sure you preserve. What I try to impress on people is trying to preserve the purchasing power of their assets. A lot of people say they want to double their money, or they want to, they expect fantastic returns. You can get fantastic returns, but the basic rule is if there's potential for high return, there's more risk implicit in the investment. So if someone is willing to gamble on a small stock on a Vancouver or Calgary exchange, then they might have a chance of making a lot of money. They've got probably a good chance of losing a lot of money too.
Do you think more people lose than gain when they're investing in more riskier kinds of investments?
I think that the average person, the average investor, is a little bit impatient, and they tend to move in and out of things. I think if you have a longer-term objective, and I'd say 1.5 to 2 years is a reasonable objective, and you're disciplined, those people, again, over 40 years would have a 5% that doesn't sound like a lot, but compound that as pension funds do over 30 or 40 years, and the numbers are significant. So someone that's patient and is selective can do very well. Someone that wants to take a flyer and invest $1,000 or $2,000 on a mining hole in the ground or a penny oil stock, 9 out of 10 of those are probably not going to work out. So those are the odds. You may have a big payday, but your percentage expectation is you're not going to make money over the long term. So patience will pay off.
When you're investing in stocks, I understand in a lot of cases you're actually investing in a company by lending them money, which I guess you're going to get some kind of a return in the end. How do you help the client establish which company they should be going for? And how do they know which company is going to be offering them the most for the money?
Again, that's a very good question, and it gets back to knowing your client, knowing what your client's objectives are, and knowing what other assets. If a person is leveraged and has a lot of real estate, then a certain investment might complement that. If someone is very conservative in their other investments, then it makes sense to go for a growth company. Let me give you an example. Laidlaw Transportation, you mentioned that you're lending money to a company. As a common shareholder, you're an owner. You're not lending your money. You'll get return in two ways. Either the price of the stock will go up or down, and you'll get some kind of annual, or quarterly in most cases, dividend. So you're either going to hopefully buy at a relatively low price and sell at a higher price somewhere down the road, plus you're getting annual dividend income. A growth stock for someone that is willing to forego income, some stocks in the Toronto Stock Exchange might have dividends of 1 or 2%, and these are typically growth stocks, companies that can reinvest their money in their own business and do a better job than you can, like Laidlaw has gone up more than tenfold in the last 10 years. A bank stock typically has a much higher dividend. They may pay a 5 or 6 or 7% dividend. So again, you're getting more annual income, but you're not expecting a tenfold increase over a period of 5 or 10 years. So you have to look at the person and say, does the person need some kind of growth, or are they more concerned about top quality and gradual growth? Because with a high growth stock, there's more risk.
Do you recommend looking into the newspaper for different kinds of investments besides companies? Like you mentioned mining before. Are the newspapers the best bet when you're doing your research?
I think newspapers are a good starting point for everybody, and I'd recommend that reading the Globe and Mail every day. If not every day, then a couple times a week is a good starting point. The Financial Post daily, and there's some other weekly magazines and newspapers. But reading, I think, is very important. The more you read, I think the better off you are. I think great places for looking for investments are walking down the center of Yorkdale. See what people. If everybody's rushing into one store, at Christmas time, they're all buying everybody wants to buy Nintendo. You've got to find out, is it possible to buy stock in the company that makes this stuff? So by just walking around, it doesn't have to be newspapers, but just seeing what is popular, I think small investors have a great advantage. You've got the opportunity to see that there's Peter Lynch subscribes to this theory. He's a very well-known and well-respected investor in the States. He says, if you see a huge plant being developed in Downsview, and you know it is owned by a large company, and you see the plant doubling in size and doubling in size again, whatever they're doing, whether you look in the plant or not, they're doing a lot of. And if it's a well-run company, to buy a stock that's 2 blocks or 3 miles down the road, just because of the fact you see trucks pulling in and pulling out, I think that could be as good an investment approach as anything else.
We're going to have to come back to the Howard P. Shore Show. We'll see you in a moment. Welcome back to the Howard P. Shore Show. So, Jeff, if I wanted to become a stockbroker, what kind of education do I need?
To become a stockbroker in Ontario, in most parts of Canada, as far as I know, you have to pass an exam, a course, called the Canadian Securities Course. And that is the only necessary requirement. There's no other, some people have varying levels of background before that, and I think a great background is a lot of economics. Accounting is also very helpful. But passing the securities course is what is required for you to become licensed as a registered representative, as I am. And beyond that, you have a variety of backgrounds.
So, Lori, I understand that you're a tax consultant.
That's correct, Howard.
What kind of education do you have to get to become a tax consultant?
I guess, Howard, there's a variety of tax consultants, or people who call themselves tax consultants out in the industry. Predominantly, those who deal with client-related matters would be chartered accountants, and chartered accountants, usually a prerequisite is a university education. Then, after finishing university education, what you do is you article with a chartered accounting firm, to get the necessary experience. Now, a lot of people who start out in this particular field do not start out as tax advisors. They actually get a broad spectrum of experience in a variety of areas, including tax, but also including audit, accounting, and other business-related areas. And then after that point, if you show an inclination and you're interested in tax, usually you move into that area where you specialize in tax and spend essentially 100% of your time dealing with tax matters, both personal and corporate.
So what kinds of services do you offer for your clients?
The services are quite varied in respect of tax. A lot of the tax consulting that we do is in the personal tax area, where we will have clients come in with various personal tax questions with respect to completing the personal tax returns, doing some personal financial planning for them to try to keep their tax costs at a minimum. A lot of times when you get into more exotic type things, you get into things like corporate reorganizations, where we actually try to structure the organization of various companies that might be under one family group, for example, to get the most tax-effective scheme in place, whether it be by getting other family members involved in the business, whether it's owners of the business or things of that nature, essentially.
How have taxes changed over, let's say, the last 15 years?
That's an interesting question. Obviously, I've been a tax practitioner for the last 15 years. I've essentially been in it for the last 10 years, so obviously I'll restrict my comments to the last 10 years. But with respect to tax, I think things are drastically more complex than they were 10 years ago. And if you speak to some of the more senior members, people who have been in tax for a longer period of time, when the Income Tax Act, essentially, which governs a lot of the tax rules that we deal with, used to be, I guess, a book of this volume. Now, if you're looking at an Income Tax Act, it's essentially about this thickness. I mean, so the rules have become incredibly complex, no matter what type of transaction that you're dealing with. From the simplest to the most complex, there's there's a variety of rules that come into play that interact no matter what the transaction is. And I mean, if I sort of had to sum it up in a simple sentence, probably complexity is the most drastic change that's happened in the income tax area. Where I mean, it's getting to the point where a client comes in and he sees you, and if you're a good practitioner, a lot of times it's difficult to give them a shoot-from-the-hip response in terms of giving them an answer right then and there. I mean, what's happening these days is there's more and more research involved before you can actually give a client a reasonable response to most questions.
I guess nowadays, with your taxes, since it seems to be getting more complicated, I guess you probably would find more people are depending on going to tax consultants.
Absolutely. I mean, that's very much the case. It's almost, I sort of, with respect to my own clientele, I mean, I have a simple dictum. What I tell my clients is don't do anything of a financial nature before you speak to me. Because, I mean, if you have clients that are going into transactions and they don't consult you, and then they sort of come to you after the fact, well, this is what I've done. Sometimes it's difficult to get them out of a mess that they might have put themselves into. So, I mean, the philosophy that I follow is if you're going into a transaction, hey, speak to me beforehand, because, I mean, maybe there's a way that we can structure what you want to do so that we can achieve your objective. Much simpler to do if my client comes to me before the transaction structure as opposed to after the transaction.
If I can just cut in for a second, I know that in my limited dealings with accountants, being an accountant myself previously, I'm impressed that by talking to somebody up front, you can probably more than save your accounting fees by having it set up and done properly. Because the average person cannot keep on top of everything. That's why you require an expert to be there to give you the guidance up front. Coming in after the fact, it can be a very costly thing, but your fees and then some are probably going to be well covered, and you'll have the peace of mind that you're doing it right.
Do you feel that...
Lori's my accountant, by the way.
Good words of advice, Jeff.
You save me money.
I'm sorry, just cutting in. Do you feel that by owning property or having a large business, you can actually get more money back from the government after you're paying taxes, or perhaps maybe not have to pay as much tax as you would if you were making more smaller income?
I mean, I think that's clearly the case. I mean, it's a good question, Howard. And the larger your business enterprise is, I mean, looking at a simple comparison, you look at an individual who has a salary, and that's all he has. He works for one organization as a salary, and he comes to me and asks me, Lori, what can you do for me to keep my tax bill to a minimum? Because of the way the tax laws are structured, my hands are somewhat tied. I mean, there's not a lot you can do for that particular individual other than some basic things like an RSP and things of that nature. It all depends on that person's employment status. But if a person comes to you and he has a large enterprise, he has a corporation or he has a number of corporations that have operations, there is a variety of things that you can do for that particular individual in terms of tax planning and things of that nature, whether it means something that's called estate planning, bringing other family members in, or trying to utilize, crystallize what's known as a capital gains exemption, which is an ability to generate capital gains tax-free. I mean, those types of things can be carried out. The more complicated, the larger the person's business is. I mean, that's generally the way that things work. I mean, I can do for somebody who has a more substantial portfolio than for someone who has a smaller portfolio.
Is there any way you can actually hide your taxes from the government, or maybe put your money into tax shelters?
I mean, there are various tax shelters. I mean, obviously, I mean, in Canada we have what's known as a self-assessing system. I mean, and what a self-assessing system means, Howard, is that you have your own tax return. It's your responsibility to report 100% of the income that you earn. I mean, obviously, if you're negligent in doing that, then, I mean, you're the one that's going to suffer the penalties and other consequences that arise from that. I mean, alluding to your other point when you're leading into tax shelters, there are a number of tax shelters that are out there, whether they're real estate tax shelters or mining or oil and gas shelters. Those things that are in there, and Jeff can comment on sort of the investment aspects of it, but from a business advisory point of view, what these shelters do, for example, is you put $100 into a tax shelter, and it provides write-offs. The way the rules work essentially these days is you can only write off essentially the amount that you have invested. So if you invested $100, let's say, in this shelter, you can write off that $100 and only that, even if the losses from the shelter are higher than that. So in effect, what's happening is you're getting the benefit of that write-off. So let's say you're a top-rate taxpayer, which is approximately 50%. Now, you would say $50 on that $100 investment. The other $50 of that investment, if that's not a good investment, you've basically thrown it in the air, you've thrown it away. So the critical advice when you're dealing with shelters is to look at the investment aspects of the shelter. See if the shelter is a good investment, despite the fact that you're getting tax advantages from those shelters.
Yeah, I couldn't agree more. I think that I just have a few thoughts on timing of tax shelters. Typically, a lot of shelters are rushed to the public late in the year. I'd say step back when someone calls you late in the year and tries to sell you a tax shelter. Look at it very carefully. Call your accountant. Things that are rushed in the last 2 weeks of December, sometimes they're quality. I'd say 3/4 of the time they could be lower than investment grade quality. So as Lori alluded to, unless it makes sense as an investment, you probably shouldn't touch it. And going back in history over the last 10 or 15 years, marginal tax rates for people in the top tax bracket were higher. And in the past, a lot of tax shelters made a lot of sense, more so just on the tax merits. But I'd say right now there are very few tax shelters that anybody should be looking at. They're just not that. I think they're way over promoted. They're probably oversold too. I'd be very careful.
And the key point to keep in mind with respect to tax shelters is that the government, knows of their awareness. In the past, they sort of gave you very lenient rules with respect to the types of items that you could write off with respect to these shelters. The government's taking a different side of the coin these days with respect to shelters, and they've brought in a number of rules, sort of anti-avoidance or restrictive rules, to restrict the degree of write-offs that you can get from these shelters, which essentially makes them a less viable investment alternative these days.
Howard, if I just talk about one tax shelter which people don't look at as a tax shelter, and maybe Lori can give some facts here, which are at his fingertips. An RRSP, Registered Retirement Savings Plan, especially with changes finally in the works for 1991, is probably one of the best tax shelters anybody can look at. And before you look at any tax shelter, look at yourself and say, have you made your maximum RRSP contribution? Because RRSPs are going to be huge assets for your average person. Lori, I don't know if you can give some.
I don't know if you have any specific questions, Howard, in respect of RRSPs.
Yeah, for an RRSP, anyway, as you mentioned, how do they work, and when should you start looking into them?
Okay, I'll talk a little bit about, how they work. Jeff probably has his own opinions as to when you should get in them. I certainly have some opinions in that respect as well. RSP is essentially a tax deferral mechanism. And by a tax deferral mechanism, what I mean is that you're going to save some tax dollars now. Down the road, you're going to pay tax on that savings that you're getting right now. So what it is, it's a deferral. It's not an ultimate savings, but it's probably the most widely used tax-driven vehicle in Canada today. And what an RSP is essentially it's a sponsored plan that Jeff will talk about. There's various financial institutions that offer these plans where you can make contributions up to various limits and get a tax deduction for the amount that you put into the plan. So, for example, if you put the maximum in 1990 is $7,500, and it's also based on the amount of earned income you have, which typically is employment income or business income if you have your own self-employed business. You essentially can put amounts into these particular RRSPs, maximum $7,500, and get a deduction at whatever your effective tax rate is. So, for example, if you put $7,500 in, and if you're a top-rate taxpayer, you would get back essentially about half of that amount back in taxes, so essentially save $3,750.
Just changing the topic a little bit, I know in the States you can write a lot of things off. What exactly can you write off in Canada as far as taxes are concerned?
Obviously, I guess the biggest difference, since you bring the States up, the biggest difference between Canada and the U.S. is mortgage interest. If you have your own property and you have a mortgage on the property, in the States you can write off your mortgage interest. In Canada, that is considered to be a personal expense and is not deductible. In terms of what you can write off in Canada, it's obviously dependent. I mean, and let's look from a personal tax point of view. Also, it obviously depends on what situation you're in. I mean, if you're an employed individual who's required to use his automobile for business purposes, then you can use your automobile. If you're a commission salesperson, then you're allowed to write off essentially most expenditures that you incur to earn that commission income. So that can include meals and entertainment expenses. However, there is a limitation with respect to meals and entertainment expenses, where you can only write off 80% of the cost of your meals and entertainment expenses. But you could write off any donations. Otherwise, there's basically a strict list of the types of items that you can deduct: medical expenses, tuition fees, and donations, alimony and maintenance if you happen to be in that particular situation, but much more limited than what you see in the United States.
Lori and Jeff, I'd like to thank you very much for appearing on the Howard P. Shore Show. Thank you, viewers, for watching. Good night.